Okay, so you want to own a small apartment building. Not a duplex, not a spare bedroom on a rental app. A real building, 12 units, 20 units, maybe 30, the kind of property that shows up in a broker's email with a rent roll attached and a number underneath it that looks, for a second, like it might change your life. Here's the promise everyone makes about this asset class. Buy the building, collect the rent, watch the mortgage get paid down by strangers month after month while the property quietly appreciates underneath you. Cash flow now, wealth later, tenants doing the work. Here's what they don't tell you. Most small apartment buildings don't work that way. The mechanics that make a 20-unit building profitable are almost nothing like the mechanics that make a single-family rental profitable. And the investors who don't understand the difference find out the hard way. Usually around month 14. Usually when the roof fails and the reserve account is empty. By the end of this video, you'll understand exactly how a small apartment building actually makes money. The income side, the expense side, the single number that determines what the building is worth, whether you're buying, selling, or refinancing, and the specific way regulation and leverage can turn a good deal into a very bad one. You'll understand why the same building in the same city can make one owner rich and bankrupt the owner 2 doors down. A house is valued by what similar houses down the street sold for. An apartment building is valued by what it earns. That single distinction is where most first-time buyers get lost. They look at a 20-unit building listed for $2 million and think about it the way they'd think about a home. Is that a fair price for the neighborhood, the finishes, the square footage? Wrong question. The right question is, how much net income does this building actually produce? And does the asking price reflect that income at a return worth accepting? Here's the formula the entire industry runs on. Net operating income divided by purchase price equals the cap rate. If a building generates $120,000 a year in net income and it's priced at $2 million, that's a 6% cap rate. Flip the formula around and you can do the opposite. Take the income a building produces, divide by the cap rate buyers are accepting in that market, and you get the price it should trade at. That's not a rule of thumb. That's the actual mechanism setting the number on the contract. So the price isn't really set by the seller. It's set by the income statement, which is exactly where sellers start playing games. Every broker's offering memorandum comes with a pro forma, a projection of what the building could earn under ideal management. Rents pushed to market, vacancy assumed away, expenses trimmed to a number nobody's actually operating at. That pro forma is not a lie exactly. It's a sales document dressed up as a spreadsheet. The number that matters is the T12, the trailing 12 months of actual, verified income and expenses pulled from the real bank statements, not the broker's optimism. And even the T12 has a trap buried inside it, the operating expense ratio. Across the industry, a stabilized small apartment building typically runs somewhere between 40 and 50% of its income eaten up by operating expenses, taxes, insurance, management, maintenance, utilities. A pro forma that shows a 30% expense ratio isn't showing you a well-run building. It's showing you a fantasy. Here's the part that breaks first-time buyers' brains. Financing doesn't even enter this equation. The cap rate is calculated before a single dollar of mortgage payment, completely unlevered, which means 2 investors can look at the exact same building, agree completely on the income, agree completely on the value, and still end up with wildly different returns because one of them borrowed the money at 6% and the other borrowed it at 8.5%. In 2026, small balance multifamily debt has mostly priced in that range, 6% to just under 9%. Regardless of what the headlines say about rate cuts. The lender isn't asking whether you like the building. The lender is asking whether the net operating income covers the debt payment by at least 1.20 to 1.25 times. Fall short of that ratio, and it doesn't matter how much you love the deal. The loan doesn't get made, which raises the question of where that debt actually comes from. Small apartment buildings mostly don't get financed the way a house does, and they mostly don't get financed the way a $100 million tower does either. They sit in an awkward middle ground called small balance commercial lending. Local and regional banks, credit unions, and specialized small balance programs through Fannie Mae and Freddie Mac dominate this space, and almost all of them underwrite the same way. not primarily on the buyer's income, the way a residential mortgage does, but on the building's income. That's a DSCR loan, debt service coverage ratio financing, and it means the building has to qualify for the loan on its own merits, largely independent of what the buyer earns at a day job. The building isn't overpriced or underpriced. The building is priced exactly as accurately as the income statement underneath it, and that statement is the only thing worth negotiating over. Ask a first-time buyer what a 20-unit building earns, and they'll give you one number, the rent roll, multiplied by 12. That number is wrong the moment they say it. Start at the top. Gross potential income. Every unit rented every month at full asking rent with zero gaps. That number exists only on paper. No building in the world actually collects it because buildings have vacancy, and vacancy isn't a rounding error. It's a line item. Lenders underwriting a small multifamily deal typically bake in somewhere around a 5 to 7% vacancy and collection loss just as a baseline assumption before anything has even gone wrong. Subtract that, and gross potential income becomes effective gross income. That's the real number. That's the one worth building a model around. But income doesn't stop at rent. Every unit that isn't producing ancillary income is leaving money sitting on the table. Laundry machines, reserve parking, pet rent, which has quietly become one of the highest margin line items in the entire multifamily industry, because a pet doesn't cost the owner anything extra to house, but tenants pay for the privilege anyway. Storage units, utility reimbursement, where the owner bills tenants back for water and trash instead of absorbing it. None of this shows up on the sign out front. All of it shows up on the return. And here's the part sophisticated operators build entire strategies around: the gap between current rent and market rent. If a building's units are renting for $200 below what an identical unit 2 blocks away commands, that gap is not a loss. It's latent value, sitting there, waiting for a lease to expire so it can be captured. This is the entire premise behind what the industry calls value-add investing. Buy a building where rents are underpriced or the units are dated, close that gap through renovation and re-leasing, and the income rises even though nothing about the neighborhood changed. Which is where things get complicated fast, because closing that gap depends entirely on what the local government lets you do about it. In rent-stabilized markets, Los Angeles is the clearest example. That rent gap isn't automatically yours to capture. Buildings under rent control can only reset a unit to market rate when that specific tenant leaves, and long-tenured tenants have almost no financial incentive to leave. Buyers underwriting those deals in 2026 are modeling turnover as conservatively as 5 to 7% a year, not the 10% a hopeful investor might assume, and pricing in a regulatory risk premium on top of that for the uncertainty. That's why two nearly identical Los Angeles buildings, one with rents already near market, one sitting on a decade of below-market leases, can trade at meaningfully different cap rates. The income potential is the same on paper. The regulatory path to actually collecting it is not. Income on a small apartment building was never one number. It's rent plus everything adjacent to rent, minus the vacancy that's guaranteed to happen, minus whatever the government has decided you're allowed to charge for it. Here's what nobody puts in the marketing photos. The expense side is where small apartment buildings quietly die. First, property taxes. Not a flat number. In most markets, a sale itself triggers reassessment, meaning the tax bill an owner inherits after closing is often meaningfully higher than the seller was paying, because the county just watched the property trade for a number it can now assess against. Second, insurance. Across most of the country in 2026, multifamily insurance premiums have been climbing faster than almost any other line item on the operating statement, driven by rebuilding costs and claims history. And a building in a wildfire zone or a flood zone carries a premium that can reshape the entire deal by itself. Third, property management. Typically 8 to 12% of collected rent if you're paying someone else to run the building day to day. Self-manage. And that line item disappears from the expense sheet, but it doesn't disappear from your life. It becomes ours. Fourth, repairs, maintenance, and the one every new owner underestimates: reserves for replacement. Roofs, HVAC systems, water heaters, parking lot resurfacing. None of it happens on a predictable schedule, and all of it happens eventually. Underwriters typically build in reserves around 5% of income specifically, so the building isn't ambushed by its own age. Fifth, utilities, landscaping, common area costs, the unglamorous operational drip that adds up to real money across 20 or 30 units. Anyway, before we go further, if this kind of breakdown is useful to you, subscribing means you catch the next one the moment it's out. So here's the number that ties all 5 of those together, and it's the single most important sentence in this entire video. Across the industry, a healthy small apartment building typically runs somewhere between a 40 and 50% operating expense ratio. Meaning for every dollar the building collects in rent, 40 to 50 cents of it is already gone before the mortgage payment is even considered. That's the part that breaks people's brains. A building can be 100% occupied, every tenant paying on time, rent rolling in exactly as advertised, and still be a bad investment because the expense side was never modeled honestly in the first place. The rent roll tells you what the building takes in. It has never once told you what the owner actually keeps. Subtract expenses from income, and you get net operating income, not a vanity metric. The number every serious buyer, seller, appraiser, and lender in this industry actually negotiates over. Here's why NOI is treated almost like a religion in commercial real estate. It's the one number in the entire deal that's completely insulated from how the property is financed. A cash buyer and a buyer who's 90% leveraged look at the exact same NOI on the exact same building. The financing changes everything about their personal return. It changes nothing about what the building itself produces. And once you understand that NOI is the foundation everything else is built on, a strange truth follows. Raising NOI by $1 is worth more than saving $1 almost anywhere else in your life. If the market is pricing similar buildings at a 6% cap rate, then every extra dollar of annual NOI adds roughly $16.67 to the building's value, because that dollar gets divided by 0.06 when the next buyer values it. Push rents up by $50 a unit across a 20-unit building, and you haven't just added $12,000 a year in income. Depending on the market cap rate, you may have added somewhere in the neighborhood of $200,000 in resale value, instantly, on paper, the moment those leases renew. That single fact is the entire engine behind the value-add strategy that dominates this asset class. Ken McElroy, who now controls a real estate portfolio built past the billion-dollar mark through his firm MC Companies, didn't start as an owner. He started managing a 60-unit apartment building in Seattle as a young property manager, watching someone else collect the profit every month. His first personal deal was a 2-bedroom condo that cash flowed $150 a month. Small, unremarkable, but it was the first time he was the one being handed the check instead of writing it. From there, the pattern was always the same one this segment just walked through. Find a building where income is underperforming what the market will bear, fix the operating side, and let the NOI, not the market, not luck, pull the value upward. Years later, that same logic scaled into a deal where McElroy and a partner bought 2 Las Vegas apartment complexes for $85.6 million, converted the units to condos, and sold them individually for a combined $171 million, north of $30 million in profit, earned by changing how the asset was structured and sold, not by the city around it magically becoming more valuable. It's worth pausing on why this even matters at the small scale, and not just for someone running a billion-dollar portfolio. Publicly traded apartment REITs, companies like Avalon Bay and Mid-America Apartment Communities, are underneath the ticker symbol, doing exactly the same NOI math on their thousands of units that a first-time owner does on their 20. The formula doesn't get more sophisticated with size. It gets repeated more times, which means the 20-unit owner who actually understands how to move NOI is playing the identical game the institutions are playing, just at a scale where a single renovated unit can meaningfully move the needle instead of disappearing into a portfolio of thousands. NOI isn't just an accounting term. It's the lever. Everything an owner controls, rent, occupancy, expenses, ancillary income, runs through that one number before it turns into equity. Almost nobody buys a small apartment building in cash. And that's exactly where the real risk in this asset class actually lives, not in the building, in the debt sitting on top of it. Here's the mechanic. Borrow at a rate below the building's cap rate, and leverage works in your favor. You're earning more on the asset than you're paying to borrow against it, and the spread between those two numbers becomes your return amplified. This is the entire reason investors borrow at all instead of paying cash. But flip that spread, and leverage turns into the exact same force working against you. Borrow at a rate above the cap rate, and every dollar of debt you add doesn't amplify your return. It erodes it. Put a number on it. Buy a building at a 6% cap rate. Finance 80% of it at 7%, and the math already works against you before a single tenant moves in. You're paying more for the borrowed 80% than the whole building even earns. Buy that same building at a 6% cap rate, but finance it at 5%, and the arithmetic flips entirely. The borrowed money is now earning more than it costs, and that spread flows straight to the equity holder, multiplied by how much of the deal was financed in the first place. Same building, same tenants, same rent roll. The only variable that changed was the interest rate on the loan, and it was enough to turn a good deal into a bad one or a bad deal into a good one, without a single operational decision being made. That's precisely the trap a lot of small multifamily owners walked into. Buildings bought a few years ago on short-term bridge loans, underwritten when borrowing costs were dramatically lower, are now facing refinance dates into a rate environment where debt costs sit meaningfully higher than they did at purchase. The building's income hasn't necessarily changed. The cost of the debt sitting on top of it has changed enormously, and that gap is exactly where owners get squeezed. Ken McElroy has been direct about what that squeeze actually looks like from the inside. The moment an owner falls behind, the instinct is panic, when a more useful instinct is negotiation, because, in his own words, the lender does not want the property back. A bank holding a defaulted apartment loan doesn't want to become a property manager, working out a modification, extending a timeline, restructuring the payment. All of it is usually preferable to foreclosure for the lender as much as the owner, which tells you something the marketing materials never do. A small apartment building isn't just a real estate asset. It's a leverage bet on interest rates with a landlord attached. And leverage explains the scale question too. Why some operators run a handful of buildings while others, like Grant Cardone, end up controlling more than 4,000 apartment units worth over $500 million. It's rarely one enormous purchase. It's the same leverage mechanic, repeated, refinanced, and rolled forward across dozens of properties, compounding in exactly the direction the math allows it to. The building doesn't decide whether you win or lose on this deal. The spread between what the building earns and what the debt on it costs decides that. And that spread moves with the market whether you're paying attention to it or not. The pitch for this asset class is always the same word: passive. Buy the building, hire a manager, collect a check. Here's what that word conveniently leaves out. A single-family rental has one roof, one furnace, one tenant relationship to manage. A 20-unit building has 20 of almost everything. 20 leases, 20 sets of appliances aging on different timelines, 20 opportunities for a plumbing issue at 2 a.m. scale doesn't make the problems disappear. It multiplies the number of places a problem can start. That's why property management isn't a convenience on this asset class. It's closer to a requirement. And the moment you hire it out, you've reintroduced the 8 to 12% expense line from segment 3, plus a principal agent problem underneath it. The property manager's incentives are not perfectly aligned with yours. They get paid whether the building is optimally run or merely adequately run, and the difference between those two states, compounded over a 10-year hold, is exactly the difference between the return you modeled at purchase and the return you actually get. Then there's the tenant side of passive, which is arguably the least passive part of the entire business. Evictions, habitability disputes. In rent control markets, an increasingly narrow set of legal grounds for removing a non-paying tenant at all. None of that shows up in a cap rate calculation. All of it shows up in how much sleep an owner actually gets. Here's the closing reframe, and it's the one thing every buyer in this asset class eventually has to sit with. Small apartment buildings can absolutely build real wealth, The income mechanics in this video are proof of that, not a warning against it. But the owners who actually get there are the ones who understood, going in, that they weren't buying passive income. They were buying an operating business that happens to have a roof over it, one with a rent roll, an expense sheet, a debt schedule, and a regulatory environment, all of which have to be actively managed for the math to work the way the pro forma promised. The building doesn't run itself. It runs the owner who assumed it would. Every number in this video, the cap rate, the NOI, the expense ratio, assumes one thing you probably never questioned, that the building is even allowed to make money in the first place. That the government, the zoning, the tax structure all sit quietly in the background, letting the income statement do its job. They haven't always. Because 800 years before cap rates existed, there was another kind of real estate where the owner didn't collect rent from tenants. He collected loyalty, labor, and taxes from an entire population living on his land, under a legal system built specifically to make sure he never had to ask nicely. Next video, the economics of owning a medieval castle, and the surprisingly literal ways its revenue model still shows up in how modern landlords get paid.